Forget semantics. Investors are now trying to work out whether they should be connecting or ignoring the dots. The dots in question relate to the Federal Reserve's expectations of future policy. After a very interesting policy statement, projections and press conference by Janet Yellen today, I'm now joined by Cardiff Garcia of Alphaville to discuss what is the fallout for investors. Cardiff?
Mike, how are you?
Good. A lot to unpack here.
Yeah, and I agree with something that you said before we came in here, which was that this was a very Greenspan-ish performance by Janet Yellen. I mean, this was
She was very adept at kind of
this was
not
a
answering
very
the question.
wishy-washy package of communications tools
Yes.
that we had thrown at us, and I think it's a good idea to break this down into a couple of different components, right? Let's start with the statement. Everybody going into today thought that the considerable time language might be changed. We weren't sure. The idea that labor resources were being underutilized, actually both of those parts of the statement remained in place, and there was even mildly more dovish language on inflation before. The statement said that inflation was moving back towards the Fed's objectives. Now it's running below. And so if you only look at the statement, you might come away thinking, well, not a whole lot's changed, or if anything, it might be a mildly dovish statement. But of course, there was a lot more to the day than that.
Yes, there was. And in fact, it's really the projection of the Fed's dots, which refer to each FOMC member's median estimate of where they think the Fed funds rate will end up in 2015, 2016, and of course today for the first time in 2017.
Right.
And I think the takeaway here is that the Fed's saying that while we still think rates will be low for a considerable time, i.e. we may not get a rate hike until the middle of next year, when we do start to raise rates, we may be tightening them faster than the bond market thinks. And in fact, that divergence between the bond market and the Fed's own estimates has increased even more, a point that Janet Yellen did talk about in her press conference. She was very good at sort of downplaying the importance of the dots, but then she actually gave some credibility to the dots when she talked about the different outcomes, because we're all basically in a world where we're depending on the data.
Right.
So when you look at this and you look at the market reaction here, what do you think the market is basically telling the Fed now?
You know, it's tough to say, and I think Janet Yellen's point today was to try to do and say as little as possible, and essentially to punt into the next, meeting, right? When QE finally ends for good, when the announcement that QE finally ends for good takes place. There was something else she kept saying during the press conference, and this was a point picked up by our man in Washington, Robin Harding.
Yes.
She kept saying that the considerable time language wasn't subject to a mechanical interpretation, right? So before people thought the considerable time might mean 6 months, I think she wants to maintain as much flexibility as possible for the Fed to start tightening and then for the pace of actual tightening after it starts, right? And I don't know if she succeeded in doing that because, frankly, it was tough to know exactly what to take away from today's statement. But you're right. The dots now show a median estimate for the target rate that's higher than it was before. And, in fact, it's been going up consistently in the last few meetings. And that's kind of interesting because we also still have in the FOMC statement itself the language saying that that the rate might stay below what you'd expect even after the economy returns to mandate consistent levels of inflation and employment. To be honest, I think there's a lot to chew over there, and it's not exactly clear if there was a general message that Janet Yellen wanted to give off today. I think she just wanted to essentially convey that this is all going to be driven by the incoming data, by the pace of progress towards the Fed's objectives. It's not set in stone, and so even though she didn't want her earlier statements to be misinterpreted as the Fed is going to definitely tighten in the first quarter of next year, she didn't want to rule anything out either. And again, it's tough to say if she succeeded in doing that, but I think that was probably the intent.
Well, I think she actually left her mark on the bond market, because if you look at the reaction here, there was a lot of selling pressure came into the euro-dollar futures complex, and we saw 3-year and 5-year yields pick up quite a bit. So, and there's a flattening going on the yield curve. The dollar is in a very nice bullish trend, and that continued to gain speed. I think the interesting thing here is the equity market. The equity market initially rallied. In fact, we were getting very close to an intraday record on the S&P, got just shy of there. But then we came back. And I think for equities, it's still unanswered. How is the equity market going to perform once QE really does end next month? And can it take the baton from the Fed's years of easy money policy and absorb future rate hikes? That's really the one big unanswerable question at the moment, I think.
Yeah.
And I think the real takeaway here now is that if you do get a good jobs number at the beginning of next month and an upward revision to the data we saw from August.
Well, but we'll also be into the next earnings season.
In the next earnings season,
you know?
we could very well get a much bigger repricing going on in the bond market, a much stronger dollar, which in turn spills over into the EM world and has all sorts of unknown consequences. And equities could be in a bit of a pickle.
Yeah, and I agree about I agree with your point about the equity market issue being unanswerable. So I won't try to answer it. Right. I'm going to talk about the dollar instead because this is really intriguing. All throughout the summer, the dollar strengthening, especially against those currencies backed by central banks that are expected to ease soon. Certainly, nothing today contradicted that movement. I think if anything, it reinforced it. Right. And by the way, it's something to keep in mind here, that the dollar strengthening at some margin begins to add a little bit of disinflationary pressure to the economy. Now, keep in mind what's happened.
We are seeing that, though, I think.
And keep in mind what's happened throughout the summer. The pace of jobs growth slowed a bit, but also inflation is moderated throughout the summer. This morning's CPI numbers, the third consecutive decline in year-on-year core and headline CPI. That's something to watch as well. And it also suggests that, by the way, if we keep talking about the move back towards full employment, if inflation remains well below the Fed's target for much longer, the Fed's going to find itself in a situation where it's definitely not going to be able to raise rates as fast as maybe some people expect. So it's just something else to watch.
Absolutely. And I think the bond market's definitely paying attention to that. And we're seeing that with the inflation expectations coming down. So, well, I suppose we'll just have to wait until October. Yeah, monetary policy, for those who thought it would be less exciting now, I think they were wrong. Thanks, Cardiff. Pleasure.